Thank you. So I will just quickly run through who we have speaking and then hand over to them to start. I think Becca's there in the room and she's our first speaker for this session. So Becca is, so we have Becca, Lee, Pete and Nicole all presenting as part of this session. Becca is the Deputy Director for Household Resilience at the ONS, responsible for leading statistics on topics including household finances, housing, skills and time use. Prior to this, she's also done a couple of Deputy Director roles for the analysis function and migration statistics at the ONS. Lee joined the ONS as a government senior statistician in 2019 and is currently leading the household income and expenditure team and has worked on household finances for the last 6 years. His area of interest is the development of household finance statistics, and prior to working at ONS he was head of science faculty and secondary biology and science teacher for 14 years, so quite a change in career for Lee. And then we have Pete, who heads up the Wealth and Pensions Analysis team at ONS, overseeing the publication of statistical releases, user engagement, and the development of the Wealth and Pensions micro-level outputs. And prior to ONS, he's worked at NatCen and Ipsos Mori on a wide range of social surveys, including the English Longitudinal Study of Ageing, British Social Attitude Survey, and the Millennium Cohort Study. And then finally, we have Nicole, who joined the ONS in household finances before moving to that Wealth and Pensions team with Pete, engaging with external stakeholders and producing analysis from the Wealth and Asset Survey for user requests, as well as the latest publication of household wealth in Great Britain. And in a previous role, she's worked in finance, collecting data on pensions and investments. So I will hand over to Becca in the room to start the session.
Brilliant, thanks Jen, and my colleague Lee should be getting the slides up. I think we might need to canter through these a bit to get to our section. I'll start talking in the meantime. So as Jen said, I'm Becca, really pleased to be here in the room. A good chance to say hello to a few faces working in this area, and also hello to everyone joining us online as well. So for this part of the session, we're effectively going to be moving to talk a little bit about the S in ONS, so the statistics that we produce based on the surveys that we're all talking about today. So I'm going to start by saying a little bit about why that matters, but this is probably a sort of room and virtual room of people that I might not need to tell that to. These things matter because they're important and they tell us about the world and the country in which we live. So the team published statistics covering household income, household wealth, household expenditure. It enables us to dig into inequality and distributional analysis, so giving us a sense of how things are playing out in different types of households, in different geographical regions, and by different types of characteristics. The word cost of living has obviously been used a lot in recent years. These help to understand that, so things that are affecting people in the country day by day. And it also informs important decisions and policy. So the statistics are used across government, both national and local. They're used by, again, a lot of people in this room and virtual room to do research and analysis, and that helps inform decision making. So if we head on to the next slide, I'm just going to give a very short overview of some of the sort of broader things happening in the team. I won't repeat some things because they do work, like we work really closely with Jen and our surveys colleagues, so there's a lot of interplay here before we actually get into talking about some of the statistics themselves and recent findings. But we have been looking at things like survey development. So Jen talked quite a bit about this. For us and our teams, we are thinking about the impacts of some of the changes being made. So, for example, the stopping of the SLC, working that through from the perspective of what that means for our income statistics and quality of them and how we can maintain that during some of the period where we'll have slightly lower sample sizes. We are collaborating with our surveys colleagues on things like changes to the surveys themselves and improvements. And Jen talked a little bit about some of the recent review work by the Office for Statistics Regulation. So that looked at both the surveys and, of course, the statistics themselves. So again, we are thinking through how we can make the improvements that they set out in that particular report. We've actually published some statistics. Again, I won't go into that now. I'll save that for my colleagues who will be talking through some of the findings. Behind the scenes, so Jen earlier talked about things like work to improve pipelines and how we can make processes more efficient. That spans the whole process of producing the statistics. So from my team's perspective, we've been looking at how we can make that more efficient and more robust as well. We've done quite a bit of work looking at methodology in different places. So again, my colleague Pete will talk about this a little bit more, but there was some work published earlier in the year following a review we commissioned of the Government Actuary Department to look at some of our pensions methodology and how we estimate that. And of course, stakeholder engagement. So much like today, working with all of our users to make sure we have a good sense of kind of what you need, what the challenges we're facing mean to you, what we need to prioritise, but also working across the government statistical service. So again, with some of the departments who are in the room here to think about things like coherence. So we have a published plan, and that basically looks at the fact that there are different sets of statistics in this particular space. A lot of you will be familiar with the fact that not all of them align in all places, but we want to do more to make sure we are looking at that and bringing things together to be more consistent where that is the right thing to do. So we have a plan that will focus on that as well. So if we move on to the next slide. So a few of the things that are coming up for us. So further survey developments. Again, I won't talk lots to that now because I think Jen's covered a lot of that obviously in more detail before we had the break. From our processes, we're continuing to improve some of those pipelines, as I said. We're also looking at how we can try and get some more cross-cutting insights around our surveys and our statistics. So they're often those kind of blocks of income, expenditure, wealth. Where can we do more to bring that together to get further insights that bring those stories together more? We've got further statistical publications coming up. So we'll have our next iteration of family spending statistics in the summer, and in autumn, the next iteration of effects of taxes and benefits. So that's an income-focused release. And we're also doing more to try and strengthen our engagement with stakeholders as well. So we are introducing a refreshed and new expert group, particularly focused on wealth statistics. Again, that reflects some of the challenges that we've mentioned around the Office for Statistics Regulation report, and that's saying that there are things that we need to look at, which we recognise and we want to work on, but we want to bring in expertise to help us do that and make sure we're focusing on the right things. So we're establishing that. And we'll also be doing some further work around the tables and statistics we publish themselves. So thinking of effects of taxes and benefits, looking at those tables, and again, getting feedback from people about what they want to see in future. So I'm handing to Lee now. Everyone else, I think, for this session is virtual. So I'm hoping Lee's voice will pop up as well and come up on screen too. Lee, over to you.
Thank you, Becca. Can everyone hear me? Which is the case. My name is Lee Colvin, and I'm the team lead for the Household Income and Expenditure analysis team within the ONS. And I'm just going to take you through our publications that we've done this year so far, and also potential future works that we're looking to carry out. So an overview of the publications we've done so far this year. We have published average household income and inequality publications for financial year in 2024. From those articles, we found that the median disposable income did not significantly change year on year. Disposable income for the poorest households is similar to the financial year 2022 levels, and disposable income inequality did not significantly increase or change in any form over the year on year. The analysis in this presentation is based upon disposable income measure and is presented in real terms at financial ending 2024 prices unless otherwise stated. In this year's publication, we kept 3 years worth of analysis as we thought it was quite relevant due to the cost of living pressures that households were finding, and you'll see that throughout all our slides today. So the annual median income didn't change significantly between financial year ending 2023 and financial year ending 2024. For the financial year ending 2024, median income had a non-significant increase by 0.8%, which was £280, to around £36,700 for a UK household. This followed a non-significant decrease of 1.2% between the financial year ending 2022 and financial year ending 2023. For financial year 2024, mean income decreased by 1.2%, which is £510, to around £42,700. And this also followed on from a non-significant decrease of 4.7% between financial year ending 2022 and 2023. when we look at this over time, then the median income for all households grew by about 7% in the 10 years leading to financial year ending 2024, with median income increasing from around 34,300 in financial year ending 2015 by 2,400 to around 36,700 in financial year ending 2024. Median income grew at an average rate of 0.8% in the 10 years leading up to the financial year in 2024. When we look at mean income, it grew by, on average, 0.6%, around £270 in the 10 years leading to financial year in 2024, which you can clearly see from the chart on the right-hand side. When we look at the difference between the poorest and the richest fifth of households, we can clearly see the disposable income from the poorest households is similar to the financial year ending 2022 levels. For the financial year ending 2024, median income for the poorest fifth of people decreased by 2.6%, around £440, to £16,800. This followed a 2.3% increase between financial year ending 2022 and 2023. For financial year ending 2024, median income for the richest fifth of people decreased by 1.6%, of 1,140 to around 71,100, and this followed a 4.9% decrease between the financial year ending 2022 and 2023. Links to all the relevant articles are at the bottom of the slides, and you can see clearly from the chart on the right hand side here now that the poorest of households, the income has stayed relatively stable over the last 3 years, while the top income households have seen a decrease in their income. So for this year in the average income article, we decided to come up with a better data visualization of disposable income composition, and this was created between our teams and data visualization at ONS. And really we did this because we wanted to make it easier for people to see what goes into making up the main income headlines, such as gross and disposable income, and also be able to compare those across the income distribution to see how households' incomes at the top and bottom of the distribution differ due to their position. And what we came up with was this, where we came with a 2-bar approach, with 1 bar focusing on gross income, which is the top one for the all households, and then the second bar then focusing on disposable income. You can see on the right hand side then we had the total gross income value for the average UK household there, which combined then with the percentage bars along the bottom, you can roughly work out what the percentage of the household income is dependent on the different components. We can see for the gross income is made up from the original income, which is the dark blue bar, and the cash benefits, which shows the cash benefits received from the state boosts their household income. For the disposable income, you can see that disposable income is created by the removal of direct taxation from the gross income total, which then gives us the disposable income for the household, where the value for that is contained within the bar. This then, I think, shows a lovely picture, to be fair, going through across the distribution, showing that with quintile 1, that most of their gross income is equally split across that cash benefits and the original income. And as you go to distribution, you can see that then the amount of income is made up from the original income is increasing, and the amount they're receiving from the state and cash benefits is also decreasing, while the taxation, as you go up the distribution, is increasing as you go from quintile 1 to quintile 5. When we look at household income inequality, we notice that disposable income inequality did not significantly change for the financial year ending 2024. Disposable income inequality as measured by the Gini coefficient had a non-significant decrease of 0.2 percentage points to 32.9% in the financial year ending 2024, and this follows a larger decrease of 2.4 percentage points between the financial year ending 2022 and 2023. Disposable income inequality now is lower than before the COVID pandemic as of financial year ending 2020, and lower than 10 years ago of financial year ending 2015. The Gini coefficient for retired households is 27.9%, and for non-retired households it is 33.1%. So disposable income inequality, again, as a measure of Gini coefficient for retired households, is now 0.1 percentage points above financial year ending 2015 levels, where disposable income inequality for non-retired households is 2.3 percentage points lower than the financial year ending 2015 levels. Our upcoming work for this year now, we have two publications which will be coming out. We have the effects of taxes and benefits, which will come out in the early autumn. And this will be looking at the effects of direct taxation and benefits on individual and households' income. And then we have the family spending in the UK, financial year 2024, which will come out again in late summer. And this will be looking at average weekly household expenditure on goods and services in the UK. For this year and going forward, we're looking at continuing some of methods developments, which is looking at the improved combination of income and expenditure data to really help get this cross-cutting data comparing income and expenditure of UK households, looking at coherency with other income sources, and improving our cross-cutting insights for households for income and expenditure. Thank you for your time. Obviously, if you have any queries or questions, these are the relevant emails for the income and expenditure inboxes. I'm going to now pass over to Peter Dangerfield.
Hi, everyone. I just need to see if I can take control of the slides. Right. Okay. Yep, so I'm Pete Dangerfield. I've already been introduced, but just to recap, I'm the lead for wealth and pensions, and I'm going to be presenting with Nicole. What I'm going to do is go through the recent methods and quality information around the recent Wealth and Asset Survey release, and then Nicole's going to go through some of the findings from that release. Okay, I'm not sure if I needed this slide because obviously the audience, you're going to be aware of the Wealth and Asset Survey. Just to recap though, it's a biannual longitudinal study which attempts to get an accurate picture of the economic position of the nation's household. The questionnaire is very comprehensive, so it covers financial wealth, so that's saving and investments, also pension wealth. We look at property wealth and liabilities there, property debt there, also household debt, the value of personal possessions, so this is something we call physical wealth, and also just attitudes and behaviours around those things. So, as I say, I'm going to go through the quality and methods considerations for this round of the study. So we released round 8 data in January. This covers April 2020 to 2022, and you'll note that this is the pandemic period, whilst there's a longer cycle for release. So obviously we're releasing later, but also just to note, like it covers COVID, so that kind of really has to be considered with the analysis of the study. Interviewing took place over the phone for the whole of round 8. We achieved the achieved interviews dropped, so they were 17,500 at round 7. They're now 15,100 for round 8. Yeah, and there is just more uncertainty. So obviously there's that behaviour change during COVID. The modal change is important to consider. So we move from face-to-face study to a telephone-based study. We also saw some sample bias, especially non-response from renters during the round. We can speak a bit more about the kind of corrective work that we've done around that. So yeah. One of the things was an adjustment to the weighting scheme. So just to say that we did calibrate the latest census data here, but we also had to make extra calibration steps. So we added tenure as a calibration control to the data, and that really does need to be considered with the analysis of the data, particularly around things like property wealth. But that hopefully accounts somewhat for the underrepresentation of renters in the sample. We've linked to the quality and methods information we have out there at the moment. Another big change, which I think Becca's alluded to already. So we did review the pension methodology that's used to calculate the wealth value of defined benefit and pension in payment pension wealth. So the work was commissioned by ONS. The Government Actuaries Department reviewed the financial assumptions around defined benefit pension wealth. One of the key objectives, and this was coming through from some of our key government stakeholders, was stability within the pension wealth measures and total wealth measures. But this was a significant method change and constituted a reduction of 9 percentage points for median total defined benefit pension wealth, and then 35% reduction in mean pension wealth. So this wasn't a break in the time series, and something that we're looking at the moment. Also, just to note, we've already mentioned the OSR review. They looked into wealth statistics as part of wider ONS economic statistics. One of the things that happened around the study, it was deemed that we'd suspend accreditation from the wealth statistics due to some of the quality issues raised by the OSR, but also some of the other things that we've mentioned. They had some recommendations for us, which I think are very useful. So they suggested that we publish a bit more on the comparability with other data sources within our QMI. Also, we should review our decision not to publish the historic back series. That is something we didn't do for the round 8 release, but something that we're looking at now. We're also widening the user engagement. So Becca's already mentioned the expert group there. So that's a significant course of action for us. We're also improving just how we communicate the quality of the data, so making improvements to that quality and methods information, just like the interlinkage between documents is really important here, because we've got lots of quality information in different places. But also just the publication of standard errors and confidence intervals is something that we've not been able to do on WISE in the past, and something that we need to look at now. And then a big one, again, this is something that will come out in the plan in autumn, but review the end-to-end resources for production of wealth statistics, because at the moment they're not coming out in a timely enough fashion. And just in terms of some recent improvements, so I would say released the scape-based annuity factors. So these were underpinning our methods change, and we've recently released those so that users can explore those and use those themselves to calculate pension wealth. We've also launched a wealth and assets expert group, as Becca mentioned. We're making updates to our quality information within all our outputs. And we plan to produce this a plan for collection and processing work, which should be published in the autumn. Okay, I'm going to hand over to Nicole, who can run through some of the findings from the latest report.
Hi there, yeah, so as Pete said, my name's Nicole, and I'll be presenting some of the findings from the Wealth and Asset Survey round 8, which covers the period April 2020 to March 2022. I'm just going to check. Pete, are you controlling the slides? Can you move on to the next slide for me, please? Yeah, that's great. So first up, we've got median household wealth, excluding private pension wealth, was 181,700 for April 2020 to March 2022. Excluding private pension wealth allows us to track the changes over time whilst controlling for the recent pensions methodology change that Pete's just discussed. And just for reference, the greyed out vertical line on the graph highlights where the survey moved to financial years from waves to rounds. And on the graph, we can see there was a 4% reduction in nominal median household wealth, excluding private pension wealth, between round 7 and 8. So this was from 189,000 to 181,700. Overall, median household wealth, not excluding private pension wealth, was 283,700. Next up, so we can see the composition of household wealth. We can see the majority of household wealth is formulated from property wealth, which is at 40%, and then private pension wealth at 35%, and this is followed by net financial wealth at 14%, and then physical wealth at 10%. Next up, we were looking at the household wealth by the age of the household head, and we can see that wealth accumulates up to retirement age and then declines at state pension age where pension wealth is used. So the gradual increase from around 15,000 for those aged 16 to 24 to over 500,000 for those aged 65 to 74. So this is likely due to younger individuals having little property wealth, and older individuals who own property wealth may have benefited from an increase in house prices over their lifetime. Older households also typically have more years of active contributions to private pensions than younger groups. And then just towards the end, there's a decrease for those aged 75 and above, and this is likely due to the fact that these people will be spending their pension wealth. Yeah, so next we thought it would be particularly interesting to look at financial wealth for this period, considering the lockdown restrictions during the COVID-19 pandemic. So this saw the closure of shops, restaurants and bars, and we found that median household financial wealth increased from round 7 to round 8. A household finance and savings article found that the rates of household savings peaked, which was attributed to forced savings as people just had fewer opportunities to spend. And we found that median household financial wealth increased by 25% after adjusting for inflation, from £8,300 in round 7 to £10,400 in round 8. The chart on the left shows the breakdown of financial wealth by age of the household head, and those aged 25 to 34 had the biggest percentage increase, which was 191%, and this is £800 in monetary terms. Those aged 65 to 74 had the biggest increase in monetary terms at £3,000, and this was a 12% increase in financial wealth. The 16 to 24 age group saw a slight decrease from £300 to £100, as well as the age group 55 to 64, which saw a decrease from £15,800 to £15,600. The chart on the right looks at median household financial wealth by economic activity of the household head. And here we found that household heads who were employed or self-employed saw the greatest increase in financial wealth compared to those who were retired or economically inactive. Yeah, so just lastly, we looked at the distribution of wealth, and we found that wealth is unequally distributed across the population. So looking at median household wealth by region in Great Britain, in the map on the left, we found that the wealthiest region was the southeast, where median wealth was around 490,000, and this is indicated on the map with by the darkest blue colour. And then the northeast was the least wealthy region, where median wealth was around 180,000, and that's the lightest green on the map. Looking at median value of household wealth components by household wealth deciles and the top 1%, we found that the wealthiest 1% of households hold 10% of all household wealth in Great Britain, and this is the same proportion held by the least wealthy 50% of households combined. The wealthiest 10% of households had wealth of £1,200,500 or more, whilst the least wealthy 10% had £16,500 or less. Overall, we found that household wealth was distributed considerably more unequally than household income. And that's all for findings. If you do have any questions, please do reach out to us on the email on the screen, and we'll get back to you as soon as we can. But otherwise, I think I'll open up for questions for the presentations that we've just gave. Thank you.